Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. Real quick, give us a follow on Twitter at Tusk Media LLC. Also on Facebook, facebook.com/Tusk Media LLC. I am Andrew Hall. Joining me this morning, Ben Nye. Ben, how are you?
I'm doing well.
Good. Glad to have you. We are jumping right in. It's earnings season again. We were just talking about how we feel like we were just making videos like this for last earnings season. But it's kicking off Thursday, April 13th. Things that we're really going to be focusing on this week in all our analysis really are going to be some of these financials, in particular these bank stocks that are reporting on Thursday, April 13th. So with that in mind, we're going to cover some macro themes in this video, some things that we're keeping an eye on. But we'll also have videos on JP Morgan, Wells Fargo, and Citi, all individual, so make sure to check those out. But let's just jump right in. What are some themes that you think are really going to have an impact in areas that we can be learning about on a broad level in the financial space and really maybe in the market as a whole when we're looking at these three bank stocks?
Well, I think the primary aspect that people really like to look at is how is the economic data doing, because that translates to interest rates. The perception is that higher interest rates are good for banks because they can make more net interest margin. In addition, you're talking about regulation, but I think the primary focus is going to be what's the path of interest rates? And to get a read on that, I think it's worthwhile taking a look at macro data. And so you want to take a look at both the inflation data and also the employment and general economic trend indicators. So if we look at the inflation, a great indicator of inflation is actually wage growth.
Right.
So what we're seeing is that wage growth is over 3% on a year-over-year basis. Full time is between pushing 4%,
which is really strong.
That's really strong. And perhaps the most interesting statistic that we have is the growth in job stayers versus job switchers. So job switchers are making a pretty significant spread over job stayers, which means that employers are going to have to pay more to retain employees, and people are really willing to pay up in order to attract more valuable employees.
Hopefully Matt Burton, our firm's founder and owner, is watching this video.
Right. And then on some of the broader economic data, you look at the Citi Surprise Index, which took a little bit of a hit after that jobs report on Friday, but it's still very healthily positive. Jobless claims continue to trend downwards. And then some of the employment indicators out of the ISM. Obviously, we had this last Friday's NFP number that was relatively weaker, but I kind of view that as an anomaly. Year to date, what we've seen is, since the election really, manufacturing employment as judged by the ISM indicator has really spiked up and is well above its moving average. And then for the services are a little more mixed, but it kind of echoes what has been touted in DC and what is being prized right now in terms of, we really want to loose the shackles on the United States manufacturing economy. Services are kind of treading a little bit of water.
It's going to be an interesting time. You touch on all the economic data, and we do our end of the day podcast almost every day. We do that live, and we see all this data, and we get a lot of reaction, we get a lot of analysis. But I think a lot of times we really look at the financial sector as a whole as kind of a catalyst for what's actually happening in the economy. You hear it all the time. You mentioned interest rate hikes. It's going to be interesting to see kind of the read-through of this, because we also, even with just the companies reporting on Thursday that we're talking about, JP Morgan, Wells Fargo, and Citigroup, we have some dispersion as to what their previous expectations were for the economy, even as something as we would almost say clear-cut as interest rates, where I think we unanimously thought, at least in our office, there would be at least a rate hike in 2017. Citi actually didn't price one into their guidance. So you've got a good disparity.
Yeah, and people were really disappointed with that. And I know we're going to get into Citi a little later, but people were very disappointed with that when Citi came out with that last quarter, but with their guidance kind of pushing back targets. But the primary driver of that was there aren't going to be interest rate hikes this year. And we've already had one, and there's probably going to be one or two or three more this year. So when you start looking at where management has set expectations, I think that's also gives them more room. So when you're looking at earnings, it's important to look at where expectations are and where they can come in relation to that without having to do a ton themselves.
Right, and that's kind of what's interesting is kind of what's expected versus what's actually happening. Another theme that I think is interesting to kind of keep an eye on is we saw after the election, obviously the market has run up quite a bit. You saw that in the tail end of 2016, so the last 2 to 3 weeks in November, also in December, the market ran up and financials really kind of led the way.
Right.
Now we're sitting in a market that's up 5-6% depending on what index you're looking at and what time period. But financials as a whole have been pretty flat. They're not up a whole lot. The companies we're talking about this week are not up very much at all. In fact, one of them's even down. So what's interesting is you would think almost intuitively, if you were to say, hey, Andrew, here's what's happened through December. The market's going to be up 6% in the first quarter of 2017. We're going to get indications of a rate hike and possibly as many as 2 or even 3 more based on what we've heard from varying Fed presidents. I would have told you, well, financials have to really be taking off. So what's going to be interesting to see is really where that disconnect has come in. One thing that I think is on the table in terms of regulation, this might be the first chance we really get to read through on what the market and what the banks are thinking in terms of Trump's proposed corporate tax breaks and decreasing that. I think a lot of people have had the read through on the healthcare plan. He wanted to shove this down throats in a way that we thought was pretty aggressive. And because he didn't get that done, I think a lot of people are saying, oh, well, tax reform's not going to happen. It's going to be on the back burner. He's never going to get there. I think a more direct read-through is really to see how some of these financial stocks do and what they seem to think about it, when you're looking at commentary from management and things like that.
Yeah, I totally agree. And I think when you look at the CEOs that are most in tune, I mean, really it's kind of become a war of attrition among bank CEOs. I mean, you had the Wells Fargo CEO who got embroiled in that account scandal and couldn't admit his mistake. You have Citigroup that's just kind of trying to appease everyone now. And then you have, Jamie Dimon really is, and then you have Brian Moynihan at Bank of America who can't really seem to get it together. So you have Jamie Dimon who's kind of all of a sudden like taking the ringleader for the bank as far as the bank CEOs go, and so he really has Trump's ear. It seems if anyone does, it's him. So that'll be interesting as far as taxes go. What's also another aspect to that is that if the corporate tax rate declines, obviously it should help earnings on an ongoing basis. But at least in Citi's case, they have these large tax allowances that they'd have to take a haircut on. So their book value would actually decline, and which would require them to hold more capital and potentially have less capital to utilize for the regulators. So it's kind of this perverse incentive where even though there's a lower tax rate, Citi could actually be hurt, at least in the near term, because of it.
Which also lends itself to kind of the broader conversation, and we've talked about this at length, especially after the compliance conference that Garrett and I went to, but just kind of this idea of deregulation of financial institutions in particular in terms of, how should we actually view Trump's stance and his administration as it relates to things like Dodd-Frank? Are we going to get a pause? Are we going to see a bunch of these policies that haven't been implemented yet not get implemented? Is anything to get rolled back? Are we going to have things kind of de-escalate, so to speak, and with something like Citi, that certainly lends itself to something that I would think would at least merit consideration from regulatory authorities right now, especially under a new regime, where they might say, hey, this doesn't really make sense. Citi's more financially secure in terms of having a lower tax burden. Doesn't make sense that they're having to now hold more cash at a macro level.
And you talk about regulation, and it seems like that, even almost more than taxes, is just in general is could be a bigger driver than taxes. I think we're going to talk about private real estate in a little bit, and kind of that mezzanine financing that it's difficult for a lot of smaller real estate players to actually get. So it's having to be funded by more expensive cost of capital from intermediaries and certain things like that.
Yeah. So anything else to add on the macro? Good.
I think that's it. I'm interested to see where they place expectations. I think Dimon's probably going to come out pretty bullish as he does. I think Wells Fargo is going to be still in that damage limitation, and then Citigroup. It'll be interesting to see if they become more bullish on the general economy.
Yeah, those are kind of the things I'm keeping an eye on. And with JP Morgan, just kind of this operational excellence.
Yeah.
You know, how are they going to kind of pursue the mantle, so to
Yeah.
speak? How are they going to kind of continue to project out? With Wells Fargo, damage control is certainly a theme. We'll talk more about kind of the real estate market and mortgage business for Wells Fargo in that video. And then with Citi, just how do they adapt to what we're happening to see, which we think for the most part is really strong data.
Right.
So hit subscribe if you're on YouTube. We're going to hit all three of those companies this week. If you are listening on iTunes, hit subscribe, leave us a 5-star review, all that good stuff. We will talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.